How's everyone doing? Welcome to our final session of the year. In this talk, we're going to discuss what's happened with the market over the last year, but also we're going to give you our predictions and what we forecast is going to happen in the new year as well.
So it's hard to believe that we've already hit the end of 2022, and what we saw in 2022 was a big increase in interest rates. So why did interest rates go up so significantly, so fast in 2022?
That's a great question. Well, the main driving force for why rates increase is the main driving force of why everything else increased: inflation.
No doubt. So we saw inflation increase at such a rapid pace that interest rates followed that same level of a jump. Now, a second indicator in why rates went up was the Fed's decision to stop purchasing mortgage-backed securities and continue the quantitative easing that they did in 2021. So with a combination, right, of the increase of inflation and the reduction of the Fed purchase of mortgage-backed securities, we really saw the value of interest rates have to increase. Now, another thing that inflation played a big part in was our overall economy.
Yes.
So we think that now a recession is coming.
Yes.
And everything pretty much indicates that. Now, what would be some key recession indicators for you?
Yes. So one of the main key indicators for myself is when you look at some data, it appears that credit card debt has been jumping through the roof and savings has began to decrease on a nationwide scale per household as well. And why that's important is because each credit card has a max balance and each savings account has a zero balance. So as people begin to max out their credit cards and begin to utilize all of their savings, they're eventually going to need to stop spending money because they won't have the ability to spend money anymore.
Can't spend money that you don't have.
Exactly.
And when you don't have the ability to borrow any more money, eventually there comes an end to your spending. Now, another real key recession indicator is the yield curve. So this is the difference between a 10-year treasury and a 3-month treasury. So in a normal economic environment, you would have a higher value for a 10-year than you would a 3-month. Well, where we are right now and where we have been for some time this year is what's called an inverted yield curve, where the 10-year has a negative difference to the 3-month. And over the course of time, anytime we've had a sustained inverted yield curve, it's immediately led to a recession. So again, if we follow history, we will see that inverted yield curve will eventually lead to recession.
Yes.
So if we believe that a recession is coming, where do we think that's going to take interest rates headed in to 2023?
Well, the thing about a recession is it actually creates an environment, a deflationary environment. So that means that inflation is going down. And remember, when inflation is going down, it's positive for interest rates. So the golden question is, when are we going to start to see inflation go down?
So we've looked at this chart in the past, and this chart is the core CPI. And the reason we want to use the core CPI is that strips out some of those more volatile food and energy costs. So looking at the core CPI, one thing we want to follow is our month-over-month inflation and making sure that our upcoming readings are replacing our previous year-over-year readings from that same month in the previous year. And as long as we get a lower reading, then we'll have a lower year-over-year inflation number, right? So looking at when we saw October and November of 2022, those replaced October and November of 2021 with lower numbers. So we would hope, and our expectation would be, when December of 2022 comes out, it's going to replace the higher December 2021 of 0.6. And if we look ahead at January 2022 number of 0.6, February at 0.5, our our prediction is we're going to come in at lower numbers than that, right? Which is going to continue this trend of lower year over year inflation numbers. Take a sneak peek ahead even further and look at what happened in April, May, and June of 2022. And you see where you have a lot of room for improvement in upcoming inflation reports. So with lower inflation, we should see lower interest rates. That's why we have a lot of optimism going into 2023 for our forecast on interest rates.
So our official forecast and what we think is going to happen with interest rates in the first 2 quarters of 2023 is that rates will go down to the low to mid 5s. If that happens, and when that happens, what is that going to do for the housing market?
So I think we actually, our official forecast for 2023 housing predicts that we're going to still see probably low single digit appreciation in most areas. Reason for that is, as you said, a reduction in interest rates should see an uptick in buyer demand. Now, you couple that with still really low inventory numbers, and you should see a strong housing market. And if you look back at the history of time in recessions do have a strong demand for housing. So we have said it in the past, and we will continue to say it, right? Opportunities for buyers now are probably greater than they've been in previous markets. Reason for that being, less demand today, right, means more opportunity to get more flexible loan terms like seller credits, right? And less of a rush in pent up, buyers feeling stressed to have to buy in an immediate time frame.
So that's our official forecast for 2023, and we look forward to continue to update you on everything that's happening in the mortgage market. Have a good New Year, you guys.
See you next year.